Hello, my name is Guy. I'm the author of the book Business Valuation with subtitle Financial Analysis. Right, here we have a cash flow statement. If you look to a cash flow statement, it's always divided in cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. The problem is with these traditional cash flow statements, you cannot know what's actually going on into the company. So I will explain you how you have to make your cash flow statement in such a way that you will understand exactly what's going on into the company by reading the cash flow statement. In fact, in a cash flow statement, what are we doing? We are in fact consolidating, putting together a balance sheet and a P&L. So here I have a P&L. You can fix the image if you want. What is important here is the EBIT you can read. You have the EBIT, and here we have financial income and financial charges. And extraordinary income, in my example, it's a 0. We have some taxes also. Now, from this P&L and the balance sheet I'm going to show you, we are going to make a cash flow statement. Now, this is the balance sheet, but this is what we call a managerial balance sheet. Cash flow statements are made from the managerial balance sheet, also called the compressed balance sheet. Go to YouTube, put in my name, Guy Parmentier, and go to How to Read a Balance Sheet, session 1, and there I explain how you have to make a managerial balance sheet. In fact, it's very easy. You have the fixed assets, and you have also the working capital requirement, as you can see here, as one block, and here we have the liquidities. This is the asset side of the managerial balance sheet. Now we go to the liability side. If you go to the source of financing, which is the invested capital, we have capital and reserves, the equity of the company. We have the payables longer than 1 year, the long-term interest-bearing debts, and we have short-term interest-bearing debts on this balance sheet. What are we actually doing with the cash flow statement? We are going to mix and the balance sheet and the P&L together. Now, how does it work? You take the equity, and instead of taking the equity, we are going to put in here the profit from operations. So we'll do that by putting in there the EBIT. So now your first step is, that's what we call the cash flow from operations. Instead of just putting here profit of the year, we are going to work there with the EBIT. How do you do that? You have your EBIT, but you want to know the cash flow. So you're adding the depreciations, you do deduct the taxes, and you're adding the mutation of the working capital requirement, or deducting the mutation of the working capital requirement. This block is called the net operating cash flow, and is in fact taking the place of your equity. Second part is the investments. Now, what are you doing? Very easy. You take your fixed assets of the last year. You do add, in fact, your depreciations of the book year you booked with the fixed assets of the year itself. That means you take the fixed assets of the previous year minus the depreciations minus the fixed assets which are on your balance sheet of the most recent year. And then you have a cash flow from investments minus 307,000 euros. Now, remember, I told you, we are going to mix the P&L together with the balance sheet. Now, if we go back to the managerial balance sheet, what did we already put in from the managerial balance sheet into this cash flow statement? Now remember your P&L. You have already all your operational costs in here because you have your EBIT. You started with EBIT. So that means that the financial returns, the financial cost, the financial returns, they are not in here, so you put it here in cash flow from financing activities, and you put your financial return and your financial costs over here. What do you do then? You just take your loans from the beginning of the period and you compare them with the loans you have at the end of the period, and you have the cash flow from the financing activities. In my example, it's minus 900. You also calculate the cash flow from extraordinary activities. In my example, it was a 0. And I always take a cash flow from equity to be sure, and to calculate whether there have been increase in capitals or decreases in capital. So what do? I take the equity of the last year, and I actually deducting the result of the period, because the result of the period is of course already in your EBIT, minus of course your taxes and your financial return. So I deduct that one and I compare it with the beginning situation of the equity of the previous year. And then I see here a mutation of 82,000 euros. That means my total cash flow from operations, I had 1 million euros, I spent 300,000 for my investments, and I spent 900,000 by repaying debt and having interest on my debt and have some small return on my debt. And then I have 82,000 I created by a capital increase in my equity. So the total cash flow is minus 33,700 euros or dollars. Now, if you compare your begin situation of your cash situation and your end situation, you have also the same amount. So what? If you now look to the cash flow statement, now you understand exactly what's going on. You had your managerial balance sheet, the working capital requirement for the managerial balance sheet, you put here. The fixed assets, you put here. The profit and loss statement, you put in your cash flow from operation by starting with the EBIT. You do add your depreciations, yes. You deduct your taxes, you add or deduct your mutation in working capital requirement, and you have your cash flow from operations. So the total asset side of your manager balance sheet you have already. You go to the liability side of your manager balance sheet, that are your loans, you put them here. You know your EBIT doesn't have your interests, costs or returns, you put them here, and you have your cash flow from financing activities. You can have some mutation in your equity, put them here, a part in your cash flow statement, eventually some extraordinary results, and you will always have the right amount of the mutation of the cash into your company.